What's up, social media world? It's me, BP Ben Peters, coming at you with a new video from a new studio. What do you guys think? What do you think of the setup? Anyway, we need to talk. If you look at the media right now, if you go on YouTube, if you go on Google and say stock market 2023 or real estate 2023, you'll see all these gurus, all these finance experts saying, oh, the stock market is in shambles. The real estate market is in shambles. What do you invest your money in? Well, I am here to tell you today, in today's video, where you should invest your money, where you can build your biggest financial legacy for you, for your family, for generations to come. I'm going to dive deep into the numbers and use data to find out where do we invest our money when it seems like the market is in absolute shambles. But before I get into the video, please like this video. More importantly, comment. I'd love to hear your thoughts, but even more importantly, hit that subscribe button if you like more content like this. So let's jump into it. So in 2023, what is going to make the most sense for you? Where should I put my money? Should I put it in the stock market? Should I put it in the real estate market? I'm going to take me and my wife's portfolio, walk you through what I bought for, what my down payment was, if I would have taken that money and just put it in the stock market for the next 35 years and just continue to buy real estate for the next 35 years. And I'll show you at the end of the 35 years which one is better. So here's my wife and I's portfolio. I've blocked out all the addresses so that you don't see, but you can see the cost of each of my units here. We have 7 properties, 19 units, consists of 3 duplexes. You can see here's 2 units, 2 units, 2 units, 3 quadplexes, and then a single family home. What I'm gonna show you is if I were to have taken the down payment on all of these properties and just invested it into the S&P 500 starting today versus if I just bought real estate and just kept these 7 properties and never bought ever again. I put together a little spreadsheet. So my original capital invested is $478,000. That is basically all the down payments. I tallied it all up. My down payments all together, so this is all my cash invested, $478,375. Let's see what happens when that grows. Here is point number 1 of real estate. It gives you leverage. You put down this much of a down payment and it allows you to be in charge of, have ownership of a much larger asset. With that $478,000, my current portfolio is worth about $3 million. Now, let's look at the average appreciation of real estate in the last 50 years. If you look, and there's a bunch of different numbers out here, but from 1963 to 2008, on average, you have about 5.4% annually. Investopedia says 5.4%, so that's what I'm gonna use here. Let's say that we increased 5.4% every year for the next 35 years until I retire, which would be in 2058. It's a long ways away. On $3 million, 5.4%. That increase in equity in year 1, $164,000. So end of year equity or price of the home is 3.2 million, assuming 5.4%, so on and so forth. I'm not going to go through each and individual year. Now, at the end of 35 years, because that's when I'm supposedly supposed to retire, I don't think I'll ever retire, I will be in charge of $20 million worth of real estate. This is not assuming I'm buying any more real estate in the next 35 years, which most likely I will be. I will be buying more real estate. So at the end of 35 years, I am in charge of, I have ownership of $20 million worth of real estate. Most of my loans are on 30-year notes. Some are on 25-year notes. Some are on 20-year notes. So at the end of this 35 years, I will own that free and clear. Now, let's say I took that $478,000 and put it into the stock market. Let's talk about stocks. With stocks, you don't have leverage. If you put $478,000 into the stock market, that's all you have. Let's take a look at the S&P 500. Since 1965, you can assume 9.81% per year. That's assuming you are reinvesting all the dividends. So you're not living off of any of the cash flow. You are taking all the money you are earning from any of the dividend stocks and you are putting it right back in to your stock market portfolio. So at $478,000, now we're getting a much higher rate of return. We're almost doubling the rate of return. So that would gain 46 grand, end of year, 525 grand. And again, this continues all the way to 2058 when I retire. If you put that all together, again, this is in the stock market, just assuming you invest in the S&P 500, at the end of your 35 years, I will own $13,895,000, so a little shy of $14 million. So if you just look at those two differences, 20 million in real estate versus 13 million in stocks, real estate looks pretty good. And now I know what you're gonna say. Ben, real estate is messier, it's harder, you have to hire a property manager, there's more to go wrong. Absolutely, you are 100% correct. But there's already a pretty big difference between real estate and stock market, and we're just talking about appreciation. Let's talk about the second thing, cash flow. So going back to the real estate column, let's go look at your yearly cash flow. So again, this is assuming I don't buy any more properties. My cash flow every year, as of right now, $154,000. If you look at my yearly cash flow, $9,000, $25,000, and so you just add that all up minus all my expenses and everything, you're looking at a cash flow of $154,000. At the end of 35 years, I will have just putting that $154,000 into the bank, and I don't do anything. I don't reinvest into real estate or anything like that. That will be $5.4 million. Now, one thing I am not factoring in here, now year 20, I'll pay off one of my properties. Year 25, I'll pay off some more of my properties. Year 30, I'll pay off more of my properties. So this will actually go up, but we're keeping math super simple for the average person. Okay, you add that 5.4 million to the 20 million, and boom, you have $25 million at the end of your 35 years. Pretty amazing. Let's talk about cash flow of stocks here. Now again, this is investing into the S&P 500, and in order to get that 9.81%, you're reinvesting all the dividends back into your portfolio. You have no cash flow because it's going right back into the portfolio in order to get that 9.81% return on investment. Another win for real estate versus stocks. Now let's talk about number 3, the big tax savings. That this is where people really make money in real estate. Tax savings. So my total cost of housing, what I bought the properties for, this isn't what they're currently worth. I can depreciate based off the sale price of the home. All my properties all in cost me $2.1 million. I can depreciate that over 27 and a half years. I've talked in previous videos about depreciation, how it's such a tax saver. I also talked about cost segregation studies. This is not even assuming cost segregation studies. So I can depreciate a house over 27 and a half years according to IRS rules. And if you look at tax brackets, I'm married, filing jointly. I'm in the 35% tax bracket. What does that mean? I can take $2.1 million and basically deduct 35% because again, I'm depreciating this out over 27 and a half years. So it'll come a chunk every year, a chunk every year, a chunk every year. But that is a tax savings of $748,000. So we can add that to our equity. That 25 million, we're putting our tax savings in there. Again, this is a yearly savings over the 35 years. So it's not, 1 year tax savings of $750,000. No, this is a little bit every single year. So that brings our total equity, our total cash that we now have access to $26 million. Let's go over to stocks. If you look at stocks here, there's no cash flow. There's no tax savings. This is assuming you are investing in a taxable account. Now, I do know that there's 401ks, there's SEP IRAs, there's IRAs, all that kind of stuff. This is just assuming that you don't get a deduction going in, you don't get a deduction coming out. So there's zero tax savings in a taxable account. And that's why if you are investing in the market, you definitely want to make sure it's inside of an IRA, SEP IRA, 401k where you can get the deduction. Now let's talk about when I turn 65 and I want to live on the beach. I want to go live in Florida, Texas, Bahamas, whatever that may be. I've saved up all this money. I've bought 7 properties, never bought another one, and I want to take that money out. Maybe I don't want to just sit on that 26 million. I want to borrow against it so that I can live the life that I want to live in retirement. Let's talk about that. Okay, in retirement, what can I pull out of my investment in order to live off of it? Well, it's very, very, very easy to go to a bank and say, hey, I own this house free and clear. I'd like to get a mortgage on it. And they will maybe force you to do 20% down. So they will loan you 80% of the value of your portfolio. We have $26 million in our portfolio. They'll loan us 80% of that. What money can I withdraw? I can withdraw $21 million in order to live the life I want to live. Can I live on $21 million? More than likely, probably, yeah. And that is the beauty of real estate. So I can pull out $21 million, and here's the best part, because I'm loaning against an asset, that is totally and utterly tax-free. I don't have to pay a nickel of tax on that. Now, any cash flow coming in, I'm going to have to be paying taxes on that cash flow, but I can go get a loan for 80% loan to value, $21 million, totally and utterly tax-free. That is the beauty of real estate. Let's take a look at stocks. So we've already established the cash flow is none, the tax savings is none. What can I pull out to live off of? I looked on Google because I don't know what margin accounts are. Most brokerage firms allow customers to borrow up to 50% of value of marginable securities. So if you have 4,000 of marginable investments, you can borrow up to 2,000. You have a little shy of $14 million. In retirement, what can you pull out? 50%. What is 50% of $13.8 million? About $6.9 million. Let's just round it up to $7 million. Well, we've got $7 million versus $21 million. So now that we know the differences between real estate and stocks, let's take a look at if you just invest in real estate versus just invest in the stock market. You're looking at 21 million versus 6.9 million. That is a difference of $14 million. Now, I get it. I totally understand. There's a lot of people out there right now that are saying, Ben, it's so hard to get started. 100%, I totally get it. Please watch my video, how I got started for little to no money down. I partnered with people. I truly believe everybody can get started in real estate. And there's a lot of people who think, I just don't have that much money, so I'm going to put it in the stock market. Well, that's an opportunity cost. As you saw, in 35 years, that opportunity cost is going to be worth $14 million. And this is just with my portfolio. I'm going to be continuing to buy properties along the way. And I hope each and every one of you guys continue to buy properties along the way. Create that legacy, build that wealth, live a life that you never thought possible. So with that all being said, thank you so much for watching. If you liked the video, give me a thumbs up. Hit that subscribe button if you haven't already. Please throw me a comment down below. What would you like me to see compare and contrast in the future? Tell me what you did like, tell me what you didn't like. I love the feedback. We're trying to grow the channel, and I thank you so much for watching. Have a great day. Stay vertical.